And let's talk stocks because the S&P 500 coming off back-to-back weekly gains, touching a new record high late last week. Joining me now with more is Jay Hatfield, CEO of Infrasturcture Capital Management. Jay, welcome.
Thanks, Kristen. Great to be on.
Great to have you. And with the S&P near that record high, how does the market look to you at these levels?
Well, notwithstanding today's price action, it's not the greatest day in the market. We are bullish on the S&P for the year. We have a 7,000 target, mostly driven by just normal higher earnings, but also by an expected corporate tax cut down to 18%. That really increases earnings quite a bit. And we do think interest rates will moderate, which will support this pretty high multiple we're at right now.
We are getting ready to kick into high gear for this earnings season. Certainly the largest technology names reporting earnings this week, 4 of the so-called Magnificent Seven: Apple, Microsoft, Meta, and Tesla. Do you anticipate that the corporate tax cuts under the new administration will be the factor to boost earnings in the new year?
Well, we think it's a critical factor. Obviously, we do need momentum on tech. There's some questions about that. But the questions about the earnings are well timed because now we're going to get the real earnings in just a few days. So we think this sell-off's probably a little bit overdone. But to get that extra boost, so we would be 6,600 on the S&P without the corporate tax cut. You really need to get that done. And then there's more upside if we really did 15. Just seems to us there's too many competing interests, and corporate taxes never seem to really get brought up. They don't have a big advocacy. So we're trying to be reasonable, so we're confident in that 7,000 target.
Is there anything in particular, Jay, that you need to hear from the technology names this week on those earnings calls?
Well, I think particularly the chip and AI-related companies, they need to address this threat from the Chinese. And I mean, our view would be there isn't any near-term impact from it, but they're the ones who really can sort that out for the market right now. We just have a little bit of a momentum sell-off from that. But like I said, it's really good timing because then we'll get the real data, real earnings, and real projections.
Speaking of real data, also coming this week is the first Fed decision of 2025 and a press conference, per usual, from the Fed Chair Jerome Powell. What do you anticipate when it comes to rates and what the Fed Chair might set up on Wednesday?
Well, we think, like most people, it'll be a hawkish pause. This Fed is mostly dominated by Keynesians. They don't really like Trump's policies, and so they think it's going to be inflationary. Thankfully, this isn't politics, it's economics, so we're going to get real data. We think the first quarter PC data will be really cool, and the Fed will cut 3 to 4 times, but they don't know that yet, so they're not going to say anything positive at this meeting.
So the Magnificent Seven represents, let's say, 40%, right, of the broader market. That's why we focus on these large technology names, especially when it comes to earnings. Underneath the hood, underneath that 40%, how do some of these other sectors look as we make our way through January?
Well, we do think that if we're correct about rates going down because inflation's cooling off, then you will see a rotation into the non-tech names, which is, of course, happening today. We have rates coming down. And we do think also that investors should look at bonds. We just launched BNDS, it's our bond fund, because it's like days like today where it seems always great to be all in tech, but then if your entire portfolio is getting demolished, it's better to have value names, dividend names, and then also some fixed income.
What is a return that an investor could expect on bonds this year?
Well, it depends on what class of bonds. So there's basically investment grade bonds and high yield, which includes preferred stock. So our fund's a high yield fund, has an 8 yield, so you can get higher returns, and they do better when the stock market's doing better. The other funds are more driven by treasuries. They can be a safe haven if things are really bad, but you tend to get more like 4 or 5% yields on those securities.
So a mix, it sounds like, of equities and bonds. What's a portfolio that you would perhaps advise to your clients or recommend to our viewers?
Well, most conservative clients have 20 to 40% bonds. But what we do counsel is to take a little bit more risk with those bonds so you get higher yields and higher long-term returns, even though you get a little bit more volatility, but you take less interest rate risk. So fully diversified portfolio, particularly for investors more conservative, maybe older, maybe closer to retirement.
A week today that President Trump has now been in his second term. What does that mean for investors?
Well, we think that reality will be less bad than fears. Keep in mind well over probably 50% of big investors voted against Trump. So there's a lot of fears about what he will do. And so now we're getting the reality. It's going to be up and down. There's going to be a lot of announcements. But we do think that'll end up being positive. People will realize his policies are actually neutral to deflationary, not inflationary. So you get lower interest rates, more Fed cuts. So we are optimistic about the real data coming out versus the talking points from the election.
Jay Hatfield, CEO of Infrastructure Capital Management, joining me in studio. Jay, thank you.
Great, thanks, Kristen.
Great to have you.